African tax leader Regan Van Roy, and I've been running a series of talks on recent hot issues in African taxation. And today's subject is recent trends in African tax legislation. Now, obviously, with 54 countries across Africa, they've all got their own tax laws. Some have got more than one set, and they're always changing. But it is possible to pick up some trends. I think perhaps with things like the African Tax Administrators Forum and various other regional groupings and pressure or advice from the World Bank and IMF, we're seeing more and more times when we can see clear trends that more than one country adopting similar ideas. So today we're going to talk about some of those. And let's start off with looking at income tax and some of the things there. One that comes to mind is losses. Tax authorities have never liked losses, and they're probably liking them less now than they used to, which is quite an achievement. So they're looking for methods in the law of stopping you using your loss. And the two clear methods come to them, apart from just auditing you and showing you haven't got a loss. But on the law, one is to say you can only carry a loss forward for so many years. And the other one is to say you can carry a loss forward, but in any particular year, you can only set a loss against so much of your profit, some arbitrary limit. And a couple of countries we've seen now, Namibia, now Zambia as well, have said, well, we'll use both, which is a double jeopardy in some ways, in that you're now limited in how much you can use the loss every year, but also if you don't use it in time, it expires and you lose it entirely. So that's a bit unwelcome, but that's the way they're going. And you need to try to monitor your losses. This thing can make havoc with your deferred tax comps, of course. But yeah, try to monitor your losses to see where you're going on them and make sure you're using them up. And because you'll find you can't take them forward forever. What else are we seeing on income tax? There's some funny rules on gambling. Again, I think the tax authorities have been aware they're not getting enough. So we've seen some curious laws sometimes. I can think of 3 countries. It started in Tanzania, spread to Zambia, now it's spread to Ghana, where income tax on gambling companies is not based on their profit, but it's a lower percentage applied to their gambling revenue, the difference between the stakes and the payouts, broadly speaking. So that can be a bit harsh. And that industry perhaps doesn't get an awful lot of sympathy either from tax policy designers or indeed from tax authorities. They just want more money. So we are seeing more activity on that and a few other things. But as I've often said to people, there's some changes in corporate rates. Now, at one stage in the past, you'd have said, well, the main trend in corporate rates is always going up. Funny enough, we have seen some rates coming down. It's been a trend. It's perhaps still happening in Africa. So Africa brought its rates down. Nigeria is thinking about doing so, and a few others are as well, which is good. Namibia has been. So that is useful. Unfortunately, we've seen in the UK, that trend came to an end and things have started going up again, and we're starting to see that a bit in Africa. What a number of countries have done, again, they've perhaps taken a leaf out of the UK's leaf, is to come up with secondary taxes. So as well as having a main corporate income tax, you'll have a separate tax that goes on a similar base almost, i.e. one. So Nigeria has its long-established tertiary education trust fund tax and a few others, which they're talking about getting rid of or subsuming into another different tax, but it's still a tax on income, which is not income tax. Now, Ghana's got its growth and sustainability levy. Mauritius has got its climate change responsibility tax. So these are all things that would actually raise the company tax rate without being called company income tax. So these supplementary taxes are becoming an increasing trend, unfortunately. Linked to income tax is capital gains. And I think there are still some countries which don't tax capital gains, but increasingly countries are introducing capital gains tax rules. Even if it's not called a capital gains tax, it may not be, because it may be they've just included capital gains in income. And watch out for that one. But yeah, we're seeing more and more countries adopting tax on capital gains. And then once they've done that, starting to think, well, indirect disposals, they think they're losing out on the tax base if somebody doesn't sell shares in a company in their country, but rather sells the holding company of that, or the holding company of the holding company. And then they say, well, we lost out on the tax. Let's find a way of getting it, change the law to get it. Sometimes only for properly rich companies, sometimes for anything. And some of those laws, frankly, don't work very well because the thresholds are too low and it's operationally very difficult to do, either from the taxpayer side or indeed the tax authority side. But that's been a bit of a trend. Withholding taxes on on sales, yes, in capital gains. We've seen a few instances of that, but increased rates are perhaps a more common thing. So that's that aspect of capital gains, and linked to income tax also is transfer pricing, and we're seeing a lot more spread of transfer pricing rules and formalization of them, and increasingly bring them into line with the OECD's rules. So that's something we're seeing. But even where they're not formalized, that doesn't mean transfer pricing is not there. I've seen a number of people telling me, oh, Mauritius hasn't got transfer pricing rules, which is true, but it's got an arm's length rule, which is essentially the same thing. Maybe not as formalized, but in practice, they expect you to charge arm's length prices and justify those prices with OECD type documentation. So that's all on income tax. But unfortunately, the world doesn't end at income tax. We see trends across other taxes as well. Still a couple of countries which don't have VAT, and that perhaps is changing. Liberia is introducing a VAT to replace its sales tax. Nigeria has a VAT, it's just not recognizable as one, and they're trying to adopt real VAT, which is overall a good thing, but will lead to more complexity and higher rates probably, but on the face of it. But that's the one thing on VAT. The next one is trying to improve the standard of, or the auditability of it, by insisting on e-invoicing or fiscalization devices or some other tool to help the revenue see what's really going on and give them the confidence that they fully understand the taxpayers' transactions. That one we're seeing more of. Also on VAT is increasingly complicated rules on electronic sales or services provided from overseas. And this started with business to consumer sales, where rightly tax authorities thought they weren't getting the money because the consumers weren't reporting themselves for imported services. But it's spreading to business transactions, partly because the tax authorities say they can't tell the difference very easily. And it makes life perhaps simpler for them if they just impose a rule on the foreign supplier. So that is an area of increasing complexity, and yeah, it's been a top topic across the world, to be honest, but in Africa particularly so. What else are we seeing? I think money transfer taxes. Ghana's just scrapped this. That's their bit of a lie, because increasingly we're seeing countries adopting these taxes because it's quite easy. You've got a limited number of money transfer agents, and you can impose a tax on them, and they'll, or rather on the transfers they undertake for their customers, they'll pass the cost on to the customer, and it's a nice steady revenue stream for the government. Not always that welcome for the population who votes for the government, but it's a relatively easy way of them making taxes. A bit progressive, I think, but increasingly we're seeing those things happen. And once they're there, they have a nasty habit of increasing, oddly enough. And then I think the final one is not a tax at all, but it's got a kind of related side to it, and it's obviously important for the finance and legal teams in companies, and that's registers of ultimate beneficial owners, ultimate beneficial ownership. UBO documentation is becoming, or disclosure is becoming increasingly common. A lot of countries adopting rules. I'm sure FATF, Fiscal Action Task Force and others are encouraging this as well. So yes, becoming increasingly common to have to document the ultimate beneficial owners and report that to somebody, not normally the tax office, but it could be the company registry or somebody around that. And then we have to hope there's good confidentiality restrictions on that information. But yeah, that is also becoming increasingly common. Thank you for listening. If there's any issues, please contact us and we're happy to talk further. I think my prediction is, unfortunately, tax affairs in Africa will continue to get increasingly complicated, still diverse between the 54 countries, but increasingly some common trends. And the other thing is, of course, those tax authorities, they're at ATAF, they're at various regional forums, and they talk to each other and they spread good habits and bad habits between them. Thank you for listening, and bye-bye.